Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is a weekly technical analysis of Chicago wheat and Chicago corn. I'll start with Chicago wheat. There's a lot of complexity here in recent days, and by recent days I mean since the peak in November. First off, the most obvious pattern was the monthly key reversal down made in January. This was completed with a big combined daily key reversal down and bearish engulfing pattern on the last day of the month. So some pretty heavy duty incentive there, or so it seemed. Okay, so this next piece is a complex piece of technical analysis patterns recognition. So we have possibly 3, maybe 4 patterns in operation, all at the same time. The first one is a completed head and shoulders top from the beginning of November last year until early January this year. It looks a little lopsided and the neckline was breached, currently at 729. However, there was no follow through lower from the breach and the market has since turned back up again. Yet here again, this did not turn out to be a head and shoulders continuation pattern, as the market barely made it up over the top of the right shoulder in late December 2021 at 827. And did not approach the top of the head in November at 875. This is a conundrum, and one that is still not sorted out, as we shall see shortly. The one pattern that was completed and reached target was a small early to mid-January double bottom, which led into the attempt just over the right shoulder. The second pattern is one in the making. It is to look at the action from late November last year to date as a possible reverse head and shoulders pattern in construction. So far we have formed the left shoulder in December and the head, which is split in January, created by the previously mentioned double bottom. And we may now, right now, be forming the second shoulder. It all depends if prices turn back up to the neckline, currently at 838. This is not a perfect pattern, as it intuitively seems to be too high up in price. But the potential action since November 2021 does look appealing. The third possible pattern is created from using a combination of the 2 necklines from the previous head and shoulders patterns to form a possible expanding wedge pattern. Thus we have the upper wedge trend line, currently at 838, from the November last year to date potential reverse head and shoulders pattern, and the lower wedge trend line from the earlier beginning of November last year until early January this year head and shoulders pattern. This is, well, there is a certain elegance to this pattern, though once again it seems to be slightly in the wrong place. Finally, there is a possible bear channel pattern formed from the neckline, currently at 729, the earlier beginning of November last year until early January this year head and shoulders pattern, making the lower bear channel line, and the mid-November 2020 to date downtrend, currently 821, making up the upper bear channel line. This one is also interesting and has merit. Now, I know this has been a lot to process that I've thrown at you in a short amount of time, so please feel free to replay the video to see what I mean. I just want you to know how I've managed to get somewhat complex points across. Since last week's commentary, the market has risen up and away from the May 2014 high at 744 to peak yesterday at the 2013 high at 809, and turned down with a combined key reversal down and bearish engulfing pattern. And we are seemingly more likely right now to make either an immediate countering bullish thrusting or a bullish piercing line pattern. This does not bring us closer to finding out which of the previously described pattern scenarios is more likely to be true. We'll still have to see how and if these patterns play out. Chicago corn. The move up from the original July to October 2021 descending wedge pattern continues further this past week, but with some additional tweaks. The way up was started by the support offered back in November of last year by the long moving average, currently at 578. This led to last November establishing a small, very shallowly bullish bull channel, currently 581 to 607, with the long moving average acting as the core support. By mid-December, the market attempted a break higher. However, this attempt higher was swiftly battered down, but not enough to extinguish what has turned out to be a fresh, slightly stronger bullish incentive as prices created a new, more acute bull channel, currently 602 to 652. This time the driving force higher seems to have been, and still is, the more acutely rising short-medium moving average, currently at 605. This had become intertwined with the lower bull channel line since early January, but is moving up to a slightly higher rate now than the new lower bull channel line. Recently, we saw a significant move up and stabilization over the 50% Fibonacci line of the May to September 2021 move at 616. This happened 3 weeks ago, and since then we've had prices move up to the upper bull channel line, currently at 652, piercing it yesterday, but not breaking it. And it was done with a combined bearish harami and possible shooting star pattern, type 1 bearish. However, the possible spike higher opens a way for yet another pattern. It is to look at the late December last year to date action, including the possible spike higher, as a possible ascending wedge pattern. This one is very early on, but it utilizes the early January to date uptrend, currently at 621, along with the connected highs from late December, currently at 662, as the outline of the pattern. Whilst the market is now out of the original bull channel formed last year, it is still within the more acute bull channel and the new ascending wedge pattern. Thus, it is important to note that after the June 2021 high resistance at 649, which so far, despite earlier thoughts, has not looked that capable of holding prices down, we have seemingly little of note until the March 2013 high at 719. For your information, both the upper bull channel line and the upper wedge line are both higher today than the 649 level. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.